top headlines at this hour. But like I said, we are going to take on board topic 1. That is with respect to debt and liquid mutual funds. It's still, of course, a draft order being mulled, but it could become reality very soon. And when I was introducing it, I know I used a lot of jargons, but we are going to simplify all of these jargons. And I think the person who I'm going to bring on board is best at simplifying jargons. Feroze Azeez, Deputy CEO of Anand Rathi Private Wealth. Hi Feroze, pleasure having you with us as always on the Money Show. What we are looking at now is basically SEBI almost every 2-3 months coming out, tightening norms a little by little, you could say, for the mutual fund industry. And now the latest is that they want that debt mutual funds essentially mark to market all securities that they own under 30 days maturity. So what exactly does that mean for our viewers out there who are holding these debt mutual funds?
Yeah, I think point one is, like you said, the regulation is changing bit by bit. I think it's very good from an industry standpoint that it doesn't happen whole hog. It needs to be staggered so that people are acclimatizing themselves to the changes and all of it is not given once. Point two, when it comes to specifically this rule of mark to market, like you said, it's very important for a viewer to interpret what does this nomenclature actually signify. Mark to market is nothing but a term to describe that if you have a paper or a bond, you can either value it at face value or you can value it at market value, like mark to market. Whenever there are bonds which are 1 month to maturity, asset management companies were permitted to keep it at face value. Let's assume there's a bond of 2 lakh rupees. The AMC, when computing the net asset value of the fund, would consider it as 2 lakh rupees in the erstwhile regime. Now the AMC is actually ordered to compute the market value of that. If it is 2 lakh 1,000, 1 lakh 99,000, whatever is the actual traded price has to be used to compute the NAV. This phenomena of using market price is called mark to market. If you use the face value, it's non-mark to market. So gradually most of the bonds were mark to market, but there were bonds which are just 30 days to maturity were permitted to be valued at the face value, not the market value. Now that rule changes from April 1st, 2020, and coming to what is the impact? Largely this impact will be for liquid funds, because 45% of the total assets under management under this category of liquid fund, which is a whopping 2.5 lakh crores, is into less than 30 days paper. So this is the actual transmission of this. Liquid funds will actually have a change in the methodology of computation of its NAV.
So to again very simply put it, suppose I have a liquid fund paper that I'm holding and I want to redeem it, say, tomorrow. So as opposed to what goes on right now where I get the value of the NAV, if I am redeeming it tomorrow, then I would essentially have my papers that the liquid fund is holding, the value would be different. But now with this rule coming in, I would know every day what the NAV is that right?
So the NAV gets computed using hypothetical face value of the bond. Now it will change to, after April 2020, it will change to the actual market value. So what does this imply to an investor? It implies that the net asset value movement is going to be marginally more. Because in the erstwhile regime, it was constant. 2 lakhs, 2 lakhs, 2 lakhs on a consecutive day. Now it's going to be 2 lakh 1,000, it's going to be 2 lakh 500, 2 lakh 1,500. So there is going to be a marginal shift in the volatility. That's the movement in the NAV of a liquid fund. But that's going to be marginal. So that's not going to change the life of a retail investor or even an HNI investor. Who will get impacted would be the large corporates who put a few hundred crores in liquid funds over weekends. Put the money on a Friday, take it back on a Tuesday, for example. So those guys are definitely going to be impacted, and the hot money which comes into liquid fund will be a little more careful going forward.
So what about debt mutual funds? I mean, is there going to be a bigger impact in liquid funds and not so much so in debt? Because that's more common for retail investors.
Correct. Now if I put things in perspective, most debt funds, now if you look at money market funds, have 4% of their bonds currently held in that category. So 96% is anyways mark to market, so 4% is going to change. In the rest of the categories, you have ultra short term, which has 7%, and low duration, which has only 2% of their bonds, whom this rule is going to be extrapolated to. So it's the extent of the bonds you hold where this rule is applicable will determine the actual impact on the NAV of that specific category.
Okay, all right. Well, yeah, like you said, most of our investors out there, or at least the liquid funds is mostly owned by corporates who park their money, over the weekend or whatever. But nowadays, of course, liquid funds is getting very popular even among investors, and it's so easy, right? One click of the button and you have your money just transferred into a liquid fund. So all the more it was important to understand. So if I have to compare the current regime versus what SEBI is proposing or what's going to kick in with effect from the 1st of April, which one would be better? Because I would assume if you're marking to market, if a verb can be possible out of MTM, if you're marking to market, there would be more transparency, right, as to what my actual NAV is?
So I think mark to market is the best method because every investor gets the risk and the reward what he or she deserves. If you don't mark to market, one person's reward or risk can be transmitted to somebody else, which is not a good practice, which is not a good transmission of the risk return which a fund is supposed to get. So what is right to do is mark to market each paper because it's only a little clerical effort or a logistical effort on behalf of the AMC to make sure that the second decimal risk reward to specific investors is transmitted in the proportion which they've actually taken.
Okay, got it. All right. Okay, on that note, I'm just going to invite all our viewers out there to send in any questions or queries that they may be having on this topic, on the portfolio that they have currently, and of course Feroze Azeez will help you answer that. This is our Ask the Money Show segment. The number is 24990388. You can call in over there and we will get your questions and queries answered. But before we do that, let's just take some questions that we have received for now via email. And our very first question is basically on essentially a portfolio that someone has, and he does say, Mr. R.V. Rao, he writes to us saying that I've been investing in equity mutual funds via SIP right from 2011. He has an investment already of around 62.5 lakh rupees, and that's turned into 71 lakh rupees. Well, good for you, Mr. Rao. And of course, his question is that he is a long-term investor, but his question is it desirable to continue investment and keep the corpus untouched in the face of the impending slowdown, or move it to a safer fund like a debt fund or a fixed deposit till the dust settles down? It's a question I'm sure you as well been asked very often, that there's a slowdown, so should I now decrease my SIP or redeem my funds and move it to these so-called safe havens like FD or gold? So how would you advise, Mr. Rao?
So I would say, of course, the markets have been choppy. Point one is most investors actually don't like uncertainty, but the good part is uncertainty is what creates return. If you wait till all the uncertainty is over, be rest assured the return would already be made and you would be coming at the fag end of making the return, just like a retail investor ends up doing, and that's the flaw of actually coming in the last leg of the return movement. So don't be worried about uncertainty. Uncertainty is the reason why equities deliver twice more than a fixed deposit. Point one. Point two, Mr. Rao, don't use timing of the market as your risk mitigant. Use asset allocation as your risk mitigant. Having monies in debt, having monies in equity. Now, if you have 62 lakhs invested, which has transformed itself to 70 lakhs, it's important to have a certain portion of that money in debt funds as well, so that there is a plan A to the portfolio, there's a plan B to the portfolio. If the markets don't do well, at least the debt funds chip in with certain degree of stability to the portfolio. So that's my advice number two. Advice number three is continue investing, because all the damage which was supposed to be happening in the broader markets has happened over the last 1 or 2 years. Of course, the Nifty has held up on the back of about 6-7 heavy weights in it, but the broader markets has already gone through a carnage. A large portion of the stocks are already at their 52-week lows, in fact 18-month lows. So I don't see too much pain left, and I think you've taken most of the pain. Don't get out, and bounce backs will keep you out of the market forever, and that's happened to several investors when they've tried to get out of the market thinking it's further going to fall. They've been out of the market for years when the bounce backs have happened. So I would certainly use asset allocation to mitigate my risk rather than timing.
All right. Well, yeah, you're a long-term investor, so you really don't have to time the market in any manner, and you've already seen the fruits of being a patient investor, 62 lakh to 71 lakhs. Since we're talking about debt funds, Feroze, I just have a follow-up question, because this is a question we get very often on email as well, and that is, looking at the way yields are moving, looking at the way interest rates are moving. I mean, the governor as well said that, we're looking at a 5% GDP, which means there is a possibility that we may see repo rate being cut again, which basically means that interest rates in the country will go lower from here on. So in such a situation, is a debt fund good to hold?
I think a debt fund is good to hold. Debt funds, if whenever you buy debt funds, there are two kinds of risks you take. You have to be very cognizant of the fact that there are two separate risks. One is the interest rate risk, like you mentioned, Mubina. When interest rates go down, debt funds get a gain out of the fall in the interest rate in a different quantum, depending on how that debt fund is placed. The other risk which you take when you buy a debt fund, when you're lending your money, which is in effect the case when you're buying a debt fund, is a credit risk, where you lend your money and the company goes bankrupt or insolvent and does not have the capability to return your money. So these are the two risks. I think taking an interest rate risk, even at this stage, I think from a long-term perspective will not pay off, because the interest rates on a 10-year government paper has come down significantly. So point one I'm making is be very aware of the two risks, interest rate risk and credit risk. Point two, further rate cuts are possible. So use accrual fund, a corporate debt fund. I think making 8-9% over the next 3 years is still a likelihood, because corporate papers are giving far more than the government paper, so you can capitalize on this higher interest which companies of India are giving. I think corporate debt fund would be my pick.
And we've been seeing also a lot of issues. Tata Capital, Shrey, all of them had come out with a lot of NCDs. So yeah, point taken. Also, credit risk I think is more scary nowadays. We've been reading a lot in the papers about how certain companies are not being able to repay CPs, etc. So you've got to be wary of that as well. Okay, we have Samir who's joining us from Mumbai on the phone line. Hi Samir, thank you for calling in. What's your query?
Yeah, hi. I wanted to know, I wanted to invest in debt funds. So what are the best debt funds I can invest in? And I'm new to, I am more interested in investing in debt funds compared to fixed deposits. Usually I keep my money in fixed deposits. Okay. So what are the benefits if I invest in debt funds compared to fixed deposits?
Thank you. You've not invested in any other kind of equity? Okay, that was very crisp. Before I could ask him a follow-up question, he's disconnected. Okay, so basically, if you heard out his question, he just basically wants to know that just like a lot of investors out there, he's been investing in fixed deposits, but he's new to debt mutual fund investing. So essentially wants to understand the difference between the two, and of course, if you could recommend some good debt funds he could start off with.
So I think in the debt fund category, if he's beginning, he can buy the Franklin Templeton Dynamic Accrual Fund or a Franklin India Short-Term Fund. These two funds will actually have some degree of credit risk, but it's very well managed by Santosh Kamath. I think it's very well diversified credit risk, has the potential to give you 8.5-9% over the next 3 years. I think that would be my recommendation. From a second part of his question, what's the difference between a fixed deposit and a debt fund? To my mind, a fixed deposit is going to be lower on rate, point one, because getting a fixed deposit today for 3 years would give you about 7%, 7.25% at maximum, depending on the quantums you're ready to put in. But the second point is there is a tax efficiency possible, because fixed deposits give you interest income which gets added to your marginal tax rate. But debt funds give you capital gain. Under Section 73, capital gain has a tax of 20% after 3 years, and you get an indexation benefit. So the tax arbitrage for people who are in the highest tax slab is the maximum. And I think so if you have a tax arbitrage and a higher return, you can almost on a post-tax basis make 3% more. I think that's the benefit, Samir.
So just to explain once again for our viewers, what essentially Feroze was trying to say is, let's say if you want 1 lakh rupees in your fixed deposit as fixed deposit interest, that will get added to your total income. And if let's say your total income without interest was at 7 lakh rupees, it will inch you up to that 8 lakh rupee bracket. So you will end up paying more tax. That is not the case with debt mutual funds. So I hope, Samir, we've been able to help answer your question. As Feroze said, 8 to 9% in the Franklin debt fund, as opposed to just 7% that you may get in a fixed deposit, and it may go only lower now because the RBI is cutting rates and banks have to pass it on. So obviously they'll as well cut fixed deposit rates. So you've got to be a bit cautious about that. Of course, I wish you good luck as well as you kickstart your investing journey. Let's take on board our next question. We have Sarvajit Guleria who has sent in a query, and he has sent us his portfolio of roughly 3 funds, all of them from the same AMC. There's the ICICI Large and Mid Cap, the Blue Chip and the Balanced Advantage Fund, and that's it. And he wants to know that if he has to redeem one of them and invest it in the equity markets, which one should he redeem? So firstly, Feroze, is it a good idea to have all your money is parked in one AMC, or would you advise distributing it around?
No, it's of course, Mubina, as you rightly caught the point from his portfolio construct standpoint, having all of them from one asset management company when you have 42 of them needs to have a very strong reason why you have all 3 there. and I'm sure there's no case to be built where you can have all the three at once. Most often than not, when I meet people and when you see that there are all funds from one AMC, it's generally the banker being constant with the AMC. That's why generally people end up buying the same AMC. So I think you should liquidate one or two, in fact two of them, and the balanced advantage fund you can definitely move to a Invesco growth opportunities fund, and then you have an ICICI for approved blue chip, which you can move to Mirai Asset Large Cap Fund. So you'll have three different AMCs trying to work for you with different strategies, different capabilities across market capitalization to help you achieve your goal. So don't have it in one AMC, and remember this as a rule: if your banker is only recommending one AMC product, you should probably make sure that you diversify your risk across different baskets.
And we in the Money Show always there, of course, to help you out choose those individual funds. So consider redeeming one or two of them, and of course Feroze has shared his list as well, which he believes could be lucrative money-making options, to invest in. So pull it out from two of them and put it, of course, in the list that Feroze has given. Okay, we have Mr. Japesh from New Delhi who's calling us. Hi Japesh, good evening. What's your query?
Hello, good evening to both of you. I had a specific query. Given this new development that is today's topic, that you are looking at a changeover to the MTM regime from next April. Now, I have a particular investment in a liquid fund.
Okay.
I would like to know from the expert that what kind of implications would it have? Supposing I had planned that I would redeem my liquid fund only in December 2020. Now, because of this changeover, do you think there would be a lot of convulsions in my fund, say next March? And would you advise that I make a clean break from this investment and get out of it and maybe look at a reinvestment sometime later? What would be your advice?
All right, Feroze, I'll let you take that.
Yeah, Mr. Japesh, I don't think you have anything to worry about. When you're speaking about 30 days papers or 30 days bonds which are embedded in your liquid fund, this will actually maximum have an impact up to 30 days. So I don't see this as a dramatic change for an investor who has bought liquid funds, not just from a 3, 4, 5 day perspective, but you still have a holding period expected of a year and a quarter. So you have nothing to worry about. This change is only going to be a benefit to you, and that's going to be insignificant, neither a benefit nor significant benefit nor a loss for you. Your periods are far more than a 30-day period. It's largely directed towards the corporates who use this as a platform for a very short-term parking. So nothing to worry at all. Just stay the course. Whatever your purpose of redeeming the money at a point in time exists, so just stick to that, and I don't think you can actually ignore this part from your perspective, especially for having used it for a year and a quarter as a liquid fund platform.
All right, Japesh, I hope you're rest assured now with this answer. And of course, be patient as always when it comes to investing in the markets, in equity mutual funds especially. Of course, you have a liquid fund, but I hope Feroze has answered your question. Okay, next up we have Durga, who has written into us. Now, Durga is a fairly young investor. He says, I'm 25, investing in around 5 funds, Kotak Standard Multi-Cap. There's also the Kotak Emerging Equity. There's a Parag Parekh Long-Term Equity, HDFC Small Cap, and ICICI Nifty Next. It's anywhere between 5 to 6,000 that he is investing in each of these funds. His goal is wealth creation, and he has a very fixed CAGR of around 12 to 15% that he wants to earn. I think quite reasonable, really. But if you had to give a quick perusal to the selection between the capitalization that he has chosen, what would you recommend?
So I'd recommend 3 changes. Parag Parekh Equity needs to move to Kotak Standard Multi-Cap, and you have to move HDFC Small Cap to L&T Mid Cap. And the last one, which you need a change for, where you've bought an index fund, which is a Nifty 50 index. To my mind, Nifty 50 index fund has done better over the last 2 years vis-a-vis an active managed fund. But I am of a very strong opinion that's going to change going forward because the broader market was doing badly. So Nifty index funds were doing well. So move your Nifty index fund, especially for a long-term investor. Extra return which the fund manager will be able to generate with the intellect which he brings to table is going to be there. So I will look at Reliance Large Cap, which is now Reliance Nippon Large Cap kind of a fund to bring in extra 2% return. I think like Mubina, you mentioned, the expectation of 12 to 15 over the long run is not an unfair expectation, especially having taken the equity risk, and I think it will pay off if patience is something as an attribute you can have as an investor.
Must have, actually, isn't it? Not can have, must have that as an attribute, honestly. Okay, I was going to actually ask you one more question on composition, but before that, let me just bring on board our next caller, Mr. N.D. Savla from Mumbai. Good evening, Mr. Savla. What's your query?
My question is, can a public charitable trust invest in equity, mutual fund or any mutual fund?
Okay, a public charitable trust. Feroze, will you be able to help him out?
Yes, so it's very important to understand that a charitable trust which gets several tax exemptions to be classified as a charitable trust has a specific list of mutual funds which they're permitted to invest in. So it's important for you to interpret that list and make a choice within the list of funds which are approved. But there are a large list of funds which are there for the open market for your personal investments, for that matter, 1,000, 2,000, even 3,000, including the closed-ended funds which we have as an industry. But out of the 457 equity mutual funds which are in the open-ended category, there are a fewer list which you will have to go through and make a choice from that narrow subset which is allowed for charitable organizations.
All right, Mr. Savla, I hope Feroze has answered your question. On that note, we're out of time on this edition of Ask the Money Show. So Feroze, as always, thank you so much for joining us and helping our viewers understand that new norm that has come by for debt mutual funds, for liquid mutual funds more specifically, because that's where you're going to see a major part of the impact. And of course, it's mostly corporates actually that park their money in liquid funds. Not that it's of course restricted to investors, individual investors, pardon me. Straight up, if you look at a simple comparison, in fact, that's a tip I'd give all our viewers out there. Today, your savings account gives around a 4% interest rate. Yes, there are some banks who've come out and said that, hey, we offer you around 6%, but a majority of our banks offer a 4% interest rate. Put that money in a liquid fund and you'll straight away get 2 percentage points extra. So why not? And of course, with digital banking coming to the fore, it's as simple as a click of your fingers. You can invest today, redeem it 2 days later, or even tomorrow for that matter. Hence, liquid funds can give you some more return potential compared to a savings account. Of course, we do have these new norms, but like Feroze said, you don't really need to lose your sleep over that. Okay, we will do one thing. We'll take a quick break right here on The Money Show, but when we return, we are going to be decoding FM Nirmala Sitharaman's norms on The Money Show, and of course, we're also going to be bringing on board a Meet Your Fund Manager segment.